Welcome back. If you've sold real estate on a seller finance basis, meaning the buyer pays you over time instead of with a lump sum, you've likely stumbled into one of the most insidious tax traps in the entire Internal Revenue Code. Today, we're diving deep into IRC Section 453 phantom income, a mechanism that forces you to pay taxes on money you haven't actually received yet. And here's the kicker. Most real estate investors and even some CPAs don't fully understand how this works until the bill arrives. Let me paint a real-world scenario. Sarah, a real estate investor from Austin, sold a commercial property for $500,000. The buyer put down $50,000 and agreed to pay the remaining $450,000 over a 10-year amortization schedule at 6% interest. On paper, this deal looked fantastic. She was getting $5,000 per month in principal payments plus interest, generating what appeared to be strong cash flow. But when tax season arrived in April of year 2, her CPA delivered shocking news. She owed $47,300 in federal income taxes on the deal, but her actual cash received from the buyer totaled only $67,400 after expenses. She was short by nearly $12,000 in actual dollars. This is phantom income in its rawest form. Let's break down exactly why this happens and how the IRS mechanics work. Understanding the core problem. How IRC Section 453 creates phantom income. IRC Section 453 is titled Installment Sales, and it was originally designed to provide tax relief by allowing sellers to spread income recognition across multiple years as they receive payments. Sounds reasonable, right? The problem emerged when the tax code was amended, and the rules around interest taxation changed dramatically. Under current IRC Section 453C, if you finance a sale, you must recognize gain in the same proportion as your gross profit ratio multiplied by the amount realized. But here's where it gets dangerous. The amount realized includes not just cash payments you receive, but also the accrued interest on the installment obligation, even if you haven't been paid that interest yet. Consider this detailed example. You sell investment property with a basis of $200,000 for $500,000. That's a $300,000 gross profit and a 60% gross profit ratio, $300,000 divided by $500,000. The buyer finances $450,000 at 6% interest over 10 years. In year 1, the buyer pays you $33,600 in total payments, roughly $27,000 in principal and $6,600 in interest. However, because the note compounds, the total accrued interest for that year, including unpaid interest that will be compounded, is actually $23,400 according to the amortization schedule. Your amount realized isn't just the $33,600 you received, it includes the full accrued interest amount. This is where the phantom income emerges. You recognize gain equal to 60% of the total amount realized, which includes accrued but unpaid interest. So you're recognizing income on interest dollars that sit in the buyer's obligation, not in your bank account. The real dollar impact. A case study analysis. Let's walk through a comprehensive example with actual numbers. Meet James, who sold a duplex for $400,000 with a $50,000 down payment and $350,000 seller financed at 5% over 15 years. James's basis in the property, $180,000 gross profit, $220,000 gross profit ratio, 55%, $220,000/$400,000. Year 1 payment scheduled total payments received from buyer, $29,847, approximately $20,500 principal plus $9,347 interest total accrued interest, including compounding, $19,250 total, amount realized for tax purposes, $49,097, $29,847 plus $19,250 taxable gain recognized, $26,998, 55% times $49,097. James actually received $29,847 in year 1, but he must report $26,998 in taxable gain. If he's in a 32% marginal tax bracket, including state taxes, he owes approximately $8,639 in taxes on cash that's already accounted for. However, this is only the beginning. Because the interest accrual continues to compound, James's phantom income problem actually grows worse in subsequent years. Year 2 through year 5, James experiences increasing phantom income, peaking around year 3 or year 4 when the unpaid accrued interest reaches its maximum amount. Over a 5-year period, James could face $40,000, $50,000 in cumulative phantom income taxes on a deal that's generating positive but modest cash flow. This scenario plays out thousands of times annually. According to research from the National Real Estate Investors Association, NREIA, approximately 18% of real estate transactions involve some element of seller financing, representing over $85 billion in annual transactions. Conservative estimates suggest that half of these transactions have IRC Section 453 issues that go unaddressed, resulting in billions of dollars in phantom income taxes annually across the real estate industry. Asterisk asterisk, the counter-argument. Why some advisors say this isn't a problem, asterisk asterisk. Before we move to solutions, let's address the counter-argument you might hear from less sophisticated advisors. Some suggest that phantom income is actually fine because 1. It's only temporary, lasting until the note is paid off, and 2. Once the note matures, you stop recognizing phantom income, so it balances out. This argument fails on multiple fronts. First, temporary doesn't mean painless. Paying taxes for 5 years on money you haven't received creates genuine cash flow problems that can force you into unfavorable decisions. Second, the timing of tax liability matters. $1 of taxes paid in year 1 costs you more than $1 of taxes paid in year 5 when you account for opportunity cost. Third, phantom income can actually prevent you from making strategic decisions, like refinancing the buyer's note or negotiating early payment, because those actions would trigger additional recognition. Moreover, this argument ignores behavioral finance. Real estate investors often become emotionally attached to their cash flow expectations. When phantom income taxes arrive, they feel betrayed and often make poor decisions, like not setting aside adequate reserves, causing cash flow crises down the road. Asterisk asterisk, the Section 453D election. Your emergency exit strategy, asterisk asterisk. Now for the solution that real estate pros don't advertise. IRC Section 453D, titled Election to Report on Accrual Basis, offers a completely different approach. This election allows you to opt out of installment method reporting entirely and instead recognize your entire gain in the year of sale. Wait, that sounds worse. Right, actually, in many scenarios, it's dramatically better. Here's why. If you elect under Section 453D, you recognize all $220,000 of gain in year 1 on James's $400,000 sale. Yes, the tax bill is larger immediately, but critically, you avoid all phantom income taxation going forward. Your subsequent payments are received tax-free because you've already recognized your entire gain. Let's compare the scenarios over 15 years. Without Section 453D election, James recognizes approximately $180,000 in total gain across years 1-15 due to phantom income compounding, paying approximately $57,600 in taxes spread across 15 years. With Section 453D election, James recognizes $220,000 in year 1, paying approximately $70,400 in taxes upfront, but then receives the remaining 14 years of payments with 0 tax consequences. The Section 453D election costs James about $12,800 more in total federal taxes over the life of the deal. However, the timing benefit is substantial. He pays taxes in year 1 when he receives the $50,000 down payment and can better manage his tax liability. More importantly, he gains complete cash flow certainty and can safely reinvest or spend the payment proceeds without worrying about hidden tax ambushes. Asterisk asterisk, when Section 453D election makes sense, and when it doesn't, asterisk asterisk, the election isn't universally optimal. Here's how to determine if it's right for your situation. The Section 453D election makes sense when 1. You have a large down payment, 20% plus of sale price, providing cash to pay the immediate tax bill. 2. Your marginal tax rate might decrease significantly in future years. 3. You're selling appreciated property with substantial gains. 4. You want certainty and cannot tolerate phantom income surprises. Or 5. The property is commercial or investment grade, where the 1031 exchange considerations don't apply. The election becomes less attractive when 1. You have minimal down payment, under 10%, making it hard to fund the immediate tax liability. 2. You're confident you'll be in a lower tax bracket in the future. 3. You're selling a primary residence, which has completely different rules under Section 121. Or 4. You're orchestrating a complex multi-property strategy involving 1031 exchanges or depreciation recapture planning. Asterisk asterisk, advanced planning. The hybrid approach, asterisk asterisk. Sophisticated investors sometimes use a hybrid strategy. They might structure the sale as a lease option or two-stage transaction, where the first stage qualifies as a Section 1031 exchange and the second stage uses Section 453D planning. Or they might negotiate a larger down payment with the buyer in exchange for a lower interest rate, improving their cash position while reducing phantom income exposure. Another advanced technique involves using a qualified intermediary to hold the seller note and then immediately sell it to a note buyer, converting the indefinite installment obligation into an immediate cash sale. While this triggers immediate gain recognition, it eliminates phantom income entirely and provides complete liquidity, useful when you want to redeploy capital. Asterisk asterisk, the practical action plan, asterisk asterisk. If you're currently holding seller finance notes, here's what to do immediately. 1. Gather all original closing documents and note details from deals closed in the last 10 years. 2. Have a CPA calculate your cumulative phantom income exposure using IRS publication 537. 3. For any deal where phantom income exceeds 10% of stated annual payments, analyze whether a Section 453D election retroactive filing via Form 3115. Application for change in accounting method is available. 4. For future transactions, include phantom income analysis in your deal underwriting before you even make an offer. 5. Include language in your purchase agreements allowing flexibility for note modifications or early payoffs if tax circumstances change. Asterisk asterisk conclusion asterisk.